I am confused why there are so many people out there that think they need a 20% down payment on a house. And they're like, Kris, I'm buying a $300,000 house. I guess I have to put $75,000 down. And I'm like, you don't have to put 20% down, but I know what logic got us there. I know where those old wives' tales come from. And today we are going to smash them wide open and talk about the truth of what do you have to put down? What can you put down? The pros and cons. Like, let's settle the record on this one.
One shot, not a future, but sure, let's go.
So there are a couple of reasons why 20% down payment gets stuck in people's mind. The first reason is that when you buy a house and it's your house for you, the bank requires you to have this thing called mortgage insurance. And they basically say, hey, until 20% of the house is paid off, you're gonna have to pay a few $100 extra a month or whatever the cost of this insurance is, because we need a way to cover our butt. I mean, after all, we're taking a bet on you and maybe you're putting down like 3% or 5% and we're just not feeling really comfortable with you until you have at least 20% paid down. And so there's a lot of people that are thinking, oh my gosh, mortgage insurance is gonna cost me $100 or a couple $100 a month. That's like money just going down the drain. And so they're thinking, I've got to put 20% down because if I put 20% down, I got no mortgage insurance. And I remember the first time I fell in this trap, I thought, why am I about to like throw a bunch of extra money at this house to save on this tiny little fee? If you're ready to buy a home, odds are you'll need to save up money for a down payment. This represents the initial portion of a home's purchase price, and you pay it up front, so it's not part of the amount financed through your mortgage loan. And it really begs the question, how much do you actually need for a down payment? Traditional wisdom is definitely out there and it says that you need 20% of the home's purchase price as a standard. This is daunting for a lot of people. Like if we're talking about a $350,000 home, 20% is going to be $70,000. And most people are making less than $70,000 a year. So unless they're saving 20 or 30% of their income, it's going to take them years before they actually save up that 20%. And so I'm out there as an influencer in the media, connecting with people at live events, and I'm amazed at how many people are like, well, I haven't saved up my 20% yet. I'm like, it's your own home. You don't need 20%. And they're almost like, really? Oh my gosh, Kris Krohn helped me see the light. I'm like, no, this is just the facts of the game. There is another reason though why people have this 20% stuck in their head. And it's because there's a difference between what's called a primary residence and an investment property. You see, a primary residence is going to be owner occupied. That means I'm the owner, I'm buying the house, I'm gonna occupy it, I'm gonna move in, I'm gonna live in it. But when it is an investment property, it is a requirement that you put at least 20% or more down. And that's because it's non-owner occupied. You as the owner are not going to live into it. It's not your primary residence. And banks view that as a slightly higher risk because now you're running a business where you're renting out the property. How do I know you're going to manage the tenants? Do I know if you're going to do a good job? And they say, smells like higher risk. You must put down 20%. Versus on a primary residence, they say, you're going to live here and all your belongings are going to be there and you're going to invite your family and your friends over and there's going to be pride of ownership. The chances of you defaulting are a lot lower. So you know what? You don't have to put 20% down, maybe 10, maybe 5, maybe 3. Maybe nothing. I'm gonna take a hard tangent real quick for just a minute to make sure you understand this detail. When you tell the bank, I wanna live in it as my primary residence, which means I'm only gonna have, call it a 3% down payment, it doesn't mean you're promising the bank that you're gonna live there forever. You're just telling them that your intention is that you're going to live there at least for the next 12 months. But you know what? Life happens and things change, and who knows, maybe 3 months later you feel inspired to move out, move somewhere else, and all of a sudden that 3% down payment on your primary residence just turned into a de facto investment property, and you didn't put the 20% down, and you're not doing anything illegal. You're actually allowed to do that. There are, however, people that will game and scam the banking industry. And what they'll do is they'll put a 3% down but never even move in. And then 3 months later, they'll do another 3% down on an investment property that they're telling them is going to be a primary residence, except it's an investment property. And they'll do this a bunch of times. And if banks catch on, you could get in serious trouble. Okay, so it does kind of beg the conversation of, well, what should I put down? So it does kind of beg the question then, what should I actually put down as a down payment? Because the truth is, you have options. If you were to ask Dave Ramsey, he'll tell you that he has a 100% down payment program, which means he basically just buys the home cash and skips having a mortgage altogether. And for most people, that's really never gonna work. And I've made a lot of videos on why I think that's a really dumb idea. But on the other hand, you have options for putting actually a very little down. A lot depends on the type of mortgage that you choose. A 20% down payment may be traditional. It's not mandatory. In fact, according to 2023 data from the National Association of Realtors, the median down payment for U.S. homebuyers was 14% of the purchase price, not 20%. And now you might be thinking, is there a 14% down payment program? I'm like, no. That means that 13% of the people bought a home cash. Some people put 50% down. Some people put 20% down. But check out the other side of the spectrum. Conventional loans can require as little as 3% down for qualified borrowers. And then you have government programs like FHA that can be as low as 3.5% if you meet the different credit requirements. So 3%, 3.5%, these are down payments that existed 20 years ago, 10 years ago, and they are just as prevalent today. Now, there is a pro and a con to putting down such a small down payment. You see, if you put 3% down, you're like, Kris, this was amazing. I got into my house for less than $10,000, and that's pretty exciting. Now, the disadvantage of a 3% down payment is, what if you buy the house and then the market turns and it corrects 20% down? All of a sudden, it's like, I'm underwater. Right? Like I have a negative position. I bought the house for $300,000. I put a $10,000 3% down payment. So now I owe $290,000 on it, but the market went down and it's now worth $250,000. And for a moment, you're going to panic and say, oh no, like I have negative equity. Like I lost $40,000 on my net worth statement, but time is going to correct that. If you just live in the house, you can keep living there. You could even move out and rent it out and make some potentially positive cash flow on it, but with time, the market also does correct. It also does come back. You should also know that when the market goes down, it affects $1 million houses and $500,000 houses, but the closer you are below the median, like in the $200,000 range to $300,000 range, you're a lot more insulated. In other words, when you have a correction in the market, $1 million home can really feel it. Maybe it becomes a $600,000 home, but a $600,000 home might be a $400,000 home, and 400 might be 300, and a $300,000 home might turn into 270, and a 270 might turn into 250. So the lower the price is, the less volatile the market is versus these really expensive homes. This moment in the video does inspire another tangent. You see, banks normally require a 20% down payment if it's an investment property, and they'll even give you a pretty strong cut in rates if you'll do 25% down because it makes them feel more comfortable. But once in a while, once in a rare market cycle, the banks will come out and they'll get greedy to place money, and they'll start saying, on this investment property, I know it's like almost always 20% or more, but we're going to do 10% down or 5% or nothing down. That's what was happening in 2006 and 2007. And I'm going to tell you that if your bank ever offers you an opportunity to put less than 20% down on a home you're not going to occupy, don't take the deal. And I know what you're thinking. Kris, if it's 10% down, I can buy 2 investment properties. Yes, but you're not going to live in them, and you have to do something to hedge your bet. When I buy investment properties, I like to have at least 20% of the house paid off because the market can correct or go soft a little bit, and I'm still in a really strong equity position. All right, back to the video. Regardless of price or loan type, though, keep in mind that the more money you put down up front, the less you'll have to borrow, but at what cost? Borrowing less equates to lower monthly payments and less interest paid over the life of the loan, but could higher payments and more interest actually be worth putting less down? So I actually like to put 20 or 25% down with all of my partners when I invest in real estate. And sometimes they'll say, well, why don't we put 50% down? And I say, no, actually, at that magic mark, I would rather have 2 properties instead of 1, because now I have 2 properties appreciating in value, and I'm getting tax benefits on 2 properties, and I'm getting positive cash flow on 2 properties, and I've got 2 tenants that are now paying that house off for me. There's a lot of reasons why I want to stretch my money as far as I can, but honoring that rule of never going below a 20% down payment on investment properties. The traditional mindset is no matter what your loan requires as a minimum, it's in your best interest to make as large of a down payment as possible. And I throw that in the garbage with, well, you should pay off your student loan debt. Are you kidding me? That's really cheap money. Use those hard-earned savings and go invest in something and make your money work for you. You're going to have to take risks to financially get ahead. So what you got to do is take calculated risks. And you know what? Whether it's student loan debt or whether it's mortgage debt, it's usually really cheap money. Where you want to be really careful is when money is expensive, like, well, I put money on a credit card and I maxed it out and they're charging me 28% interest. I'm like, no, before you invest, you should definitely pay that off. My threshold is the difference between single and double digit. If it's less than 10%, it's usually cheaper not to focus on paying it off. If it's over 10%, it's usually time to start creating an aggressive strategy to pay those debts off, because the rest of my money, I don't want to use it to eliminate my debt. I want to use it to build an investment portfolio and make my money work for me. Kris, I'm so glad I'm watching your video because I just finished saving up my 20% and I found the house and I'm about to put 20% down. To you, I would say put down 3 or 5%. Use the rest of the money and go buy other assets. Why? Because ultimately there's only one thing that's going to financially save you. And it's not Dave Ramsey, and it's not no debt, and it's not your 401k, and it's not an IRA. It's your assets that are making money for you. And I'm going to tell you right now, you might be watching this video because you're focusing on what should I do on my primary residence for down payment. But the reason why I want to go super minimal there is because I really want to take the rest of my money and I want to own real estate and I want to own businesses. And again, I want my money working for me. If money works for me, then I don't have to work for it, which means I may not need to have a job someday. I hope today's video created clarity in your mind of what you should consider when making a down payment. And I think by now you kind of understand, in my world, it's you work really hard for very little of this. Instead of putting it all in one place, spread it out. Own a business, own other real estate. Why? Because if those assets grow and make you money, someday you don't have to. You may want to get a game plan, a multimillionaire's mindset on what I would do if I were in your shoes. And if you think you'd really appreciate that, I want you to click the link below. All I'm going to have you do is actually interact with me, ask a couple of questions, and then guess what I'm going to do? I promise you a free custom game plan where I'll be in your shoes and say, if I had your job and your life and your family and everything and I had all of your financial money, whether it was a lot or non-existent, this is what I would do to make my next $1 million. And if you'd like to know what my perspective is, I want you to pause right now. I want you to go to the bottom. I want you to fill out that information. Let me immediately be in touch with you. Let me give you a custom wealth plan to get you where you want to be. Shoot, Kris, this really brings up the question then, should I be putting my money in a 401k where I get that free match from my company, or should I put it in real estate? I wonder which one's better. Actually, this might be one of the most important videos you ever watch because there's so many people doing it wrong. And if you want to do it right, click right here and let me show you where your money's supposed to go mathematically and why.